Hey everybody, Preston Brent here with our weekly roundup. This is for the trading week ending November 9th, 2018. Well, following a month of October where we saw a lot of madness, we saw one of the worst Octobers that we've had in over a decade, where the S&P closed down a little over 7.2%. The Dow was down for about 5.4. NASDAQ was down a big whopping 9%, almost in correction territory for the month of October. We've kicked off November in a fairly strong suit, moving up in kind of what I have told our members is a reflective counter trend rally. And as I've been telling all of our members, we need to be very careful and watchful. There are a couple of key areas on the chart that I will point out to you guys. But we saw this past week a lot of things happen. Primarily, the election results given us a divided Congress. So the Dems are in control of Congress, the Repubs are still in control of the Senate. And in many respects, the markets after that happened kind of had what I guess everybody's termed a relief rally, where we moved big time right after the elections. But we got to be very careful and just consider it what that is. It's more of Novocaine than really fixing the true issues of the market. We still going to see some of the primary issues that have dominated the market still there. They haven't gone away. Primarily the Chinese trade tariffs, and of course the go forward Federal Reserve interest rate policy. So we're going to see, I think, with this divided Congress here in the U.S., healthcare, infrastructure spending, and probably defense spending still remaining strong. We'll see if others, a few others, probably pull back a little bit. Maybe a little bit more government regulation in the area of technology, primarily social media. So these are just some of the things that I'm seeing. Now, Trump is known as a deal maker, willing to walk across the aisle and cut some deals with probably Pelosi, who's going to head up the Dem side. And Trump is not as ideological as maybe hardcore Republicans are, although some could probably debate that. My view is that Trump's willing to cut deals. So I think there could be some possibility of that, possibly going forward. Now, we've also got, as I said, China is still going to be on the forefront with trade tariffs. But the other thing that I'm looking at here is a slowdown in Chinese growth. I mean, their Q3 numbers came in at 6%, which was down from a previous 6.5% in their GDP growth. So that is something that really is starting to just kind of get on my radar screen. I've also global CapEx spending. That's spending that companies do on goods that are equipment, plant and equipment that they use to increase productivity, which is what's really needed, has fallen to its lowest level since 2016. So we're seeing a global slowdown in CapEx spending. And so this all portends what everybody has already probably been talking about for a while, that we're going to see growth slow down in 2019, 2020. Now, the big key is just how much will it slow down? We've got current PE ratios at about 16.86%. Remember, we were at over 18.8 in January of this year as far as forward 12-month forward PE ratios for the U.S. market. So it has come in a pretty good little bit, primarily because the earnings growth has been so strong. As we round out the Q3 earnings numbers, we're getting double digit, 25, 26% growth. I mean, very strong numbers. And while companies now in their Q3 earnings calls are talking about, especially manufacturing companies, some of their global supply chain dislocation with the Chinese tariffs, you may be looking at other areas. We're seeing it from Cummins and Caterpillar and a few others. They're starting to surface a little bit more, and I think that will continue well into 2019. So that's going to put a focus coming up on this G20 meeting with Trump and Xi, I think around November 20th. So that is going to be a big number, a big date that we've got to follow, because all Trump's got to do is come out and say something to the effect of, we seem to be making progress, and we're going to just delay a little bit as we continue negotiations, ratcheting up our trade tariffs. Remember, there is another 15% on top of 10% already there for 200 billion in Chinese goods due to take effect the end of this year going into the first week of January. So that'd be another 15% on top of the 10% on these 200 billion, taking it to 25%. And then Trump has already threatened another round next year of another 200 billion on new sales coming in. So there's a lot of noise out there in this trade tariff issue. And then besides all the noise swirling around on that, which all analysts say is going to reduce the global growth, is the area of the Fed rate hike. A lot of people are attributing Powell's statement in October 3rd. The reason why the markets really sold off as hard as they did in the month of October. I mean, he basically came out October the 3rd and in an interview said, we want to get our rates back up to neutral as soon as we can. And we may even be a little bit more aggressive in moving our rates up. And quite frankly, our neutral rate may not be high enough. Well, that set the scene for the markets to really sell off. As I've told our members and you guys here on our weekly roundups for our trader user group, I've said over and over again, over time, price action will settle in based on interest rates and earnings per share. Those drive where prices should be. Okay. And if the markets feel growth is slowing in 2019 and 2020, which it does, then earnings per share will start on a growth basis, start to come in. And then you couple that with higher interest rates, and that just puts the competition for fresh money, new money, more away from, say, the equity market into more fixed income market, which then drives price action down lower. And then given a current steady state of forward earnings per share, that either moves up or down the PE ratios until it reaches an equilibrium point. Okay. So that is what's going to drive rates longer term. Short term, it's a voting machine. Any day the markets can move up or move down, as we've probably seen. So markets now are just adjusting to this Fed rate policy of getting to a neutral rate, according to Powell, as well as where the earnings are projected, not where they are now, because we've got double-digit growth, but where they're projected to be next year, given the state of all the other things that are in play. That is why this G20 meeting between Trump and Xi is so important, because again, if he just comes out and says we're making progress, you're going to see the markets have another move higher, much like what we had this past week on Wednesday after the election, just kind of a relief rally. So now let's go take a look at the markets here. I've got a lot on the screen here, as you can see. This is a weekly chart of the E-minis. You see a lot of these percentage pullbacks here. This one over here at 12.07%, that's how much we pull back from the January highs to making the 2018 lows. Currently right now, as I spread this out a little bit and just kind of give you a better view, let me just move this around a bit. You can see off our 2018 highs, we're down 5.71%. Okay. If we were to pull back and actually retest the 2018 lows, which is what a lot of people thought would happen, then our pullback amount would probably come in. Let me just get this down a little bit so that I can show you guys here. Our pullback would be 14.18%. So if we were to come down and actually retest the 2018 lows, which is what a lot of analysts were expecting, that would give us a 14.18 pullback. If we were to come back and test our secular bullish upsloping trend line, which started in March of 2009, that would give us right almost at a bear market pullback of 19.3% from our highs that were made in September. Okay. So we've got a number of pullback amounts, quite sizable in nature, and still maintain, by definition, a bull market. Now, keep in mind, we can actually pull back more than 20% and still maintain a secular bull market, but it'll certainly scare the children. Okay. So looking at this chart, however, I still don't believe that this down move is over with yet. Okay. Now, on a near-term basis, perhaps it's subsided a bit, but and it's waiting for the next corrective move, either up or down. But the odds still favor a down move, okay, which would take us down to the 2018 lows. That's kind of where I'm sitting right now. I do not see, looking at the MACD here, And my MACD settings are tighter than out of the box. I use 618 sticks, which is a really better setting. It's kind of like a tennis pro tightening their racket strings just a little bit for ball control, or loosening them to get a little bit more spin on the ball as they're doing backcourt lobs and things like that. So if you look at this, this is kind of where we're sitting. But let me come in here. And let me just back it out so I can give you a little bit of a huge, wider perspective. And there is the longer term trend. Now, this is the E-mini futures. It's not the cash index, which, you get the morning gaps up and down. But you can see here this huge upsloping cycle here. And eventually we're going to hit it. I mean, it's just only a matter of time before we hit it. The question is, when are we going to hit it and find possible support, or we're going to break down below it? A lot of analysts are calling for us to go into a bear market or a possible recession next year, into a bear market in 2019. Remember, you cannot have a recession without inflation. It's just damn near impossible, because the Feds, if inflationary data continues to come in benign, the Feds are going to slow down their rate hike dot plot. Right? The bond market is pricing in only 2 more rate hikes, one this December and one in 2019. The Feds are pricing in 4 rate hikes right now, 1 in December and 3 in 2019. Now, one of them is going to be right. Excuse me. One of them is going to be wrong. I tend to vote on the bond market because the Feds are overly optimistic. All right. They always have been, but they do that on purpose. The Feds like to be optimistic and be a little bit more aggressive so that they don't actually have to do anything with rates. All they got to do is come out and say something about rates and get the desired effect on the markets. And that's kind of, I think, what they're doing right now, to be honest with you. So this is the market right here. Now, if I were to take everything off the screen, so at least you can see a little bit more about the screen, you can see this pullback that we have here. Excuse me. We've got this huge area here, this huge bearish divergence. And as I was showing my members on our weekly charts, you can see we had this really nice 3, 4, 5 pattern. Okay. And we've got this bearish divergence, but what's what we call a poor man's bed. And on this Elliott wave pattern, looking at this daily, excuse me, this weekly chart here, you can see 3, 4, 5. You could probably call that a 4 leg, and that's a 5 leg, right? And this is going to be our big support right here, because it is where limited volume occurred right in that area there. So this is going to be my go, no-go line on just where the market's going to end up really in 2019. And this move down here could be considered an A-leg chop. You generally have an A leg, a B leg, and a C leg after an Elliott wave 5 on these longer term basis. Now, there could be little intermittent 1, 2, 3, 4, 5 legs and ABCs. And I'm not a big believer in getting the exact Elliott wave count down, because you can adjust these any way you want, really. But just looking at the overarching trend, they tend to work out very well, which would suggest an A-leg bottom has been established there as a pivot low, all right? And then if we come back up here, we're trying to establish a B-leg pivot high. And then we can get another depending on where that goes, then we can get a C leg pivot low here. And then the location of these pivots are going to be really key where we're going to be going. Now, this is not going to play out next week, folks. It's going to take through Q1 to really start to play out, because we're on a weekly chart. For you swing traders out there and day traders, it should be a really interesting market because vol is higher and we're getting wider moves during the day. So it does tend to make it a really interesting market to play, especially shorter term. Okay. Now, if we come in and let's go look at this on a daily basis, and then I'm going to add all of my indicators back in. What I'm watching for here, we've got a couple of key pivots, and then I will put my indicators back in and just really mess it up for you. We've got a pivot point formed there. We've got a pivot point formed there and a pivot point formed there. And if I were to extend that line, it's a thick line, but roughly around just, I'm not a big believer in going to to the penny, the levels, because markets always overshoot both up and down, right? So now the big question here is, are we going to be able to get elevation and take that pivot point out with conviction on a daily chart? Or will this be considered an interim double top? And then if we're going to come down here, make a test, try another run, and if it fails, that will then set the tune for us to come down, take out this little interim area right here, and then probably come on down and test this area down here, which would be around the 2018 lows made in February. Okay, so no one and their uncle is going to be able to tell you where we're going to be over on this time frame over here. And if they tell you they know, they're insane. They don't know. But what we do here is we follow the key pivots, both on a weekly basis, a daily basis, and then intraday. And these pivots give us a really good clue matched with volume and momentum where we're going to go. And that's really the key, folks, on all of this. We don't try and guess. We merely let the markets tell us where we're going to go. Now, the other thing that I will show here, let me just clear this off my screen for a second. The other thing that I wanted to show you guys is there's the 200 EMA. Notice right now it's gone flat. There's the 50 EMA. It's just about gone flat. So we've railroad tracked the two key indicators, and that huge, and you could call this a V bottom kind of thing right here, like that, has made these two indicators go flat. The other thing that I will point out on this is that it gives the bulls some hope. We had a good strong finish on Friday, and if you look at this, and let me just blow it up a little bit here on this daily chart, you can see here that we came right down and bounced hard off the 200 EMA and came all the way back up. Now we were down here right around the 2764 area, and we actually closed at 2778. So we moved up about 14 points towards the end of the day after algos probably kicked in and bought on a retest of the 200 EMA. That is more of a bullish sign. But again, the key for me is taking out this key pivot high right here, which is sitting right around 28, 24, 25. All right. So I'm still not convinced yet of this big run in the first couple of weeks in November that it's going to hold. Okay. Now, for those of you Elliott wave theorists out there, you can see this is a 3-leg, which would suggest a 4-leg up here and then a lower low down here with a 5-leg. That is kind of my belief as well on where this thing could go. But all of that changes if we can escape this pivot high here of 28, 24, 25, do so on volume, right? And if we get it on volume, that would be a good thing. Now, I will show you, speaking of volume, it's not a good news kind of thing, right? You can see this move right here where we made new lows. We took out that key pivot low and we made a new pivot low right here on the basis. And you can see all of that was met by increased volume. This purple line is a 5 EMA. This blue line is a 20 EMA. And when the purple is above the blue, volume's increased. And volume increased as we were moving down like that. Now look at it as we moved up right here. And as we moved up, what did volume do? It went down dramatically. So that's what we don't want to have happen. When prices move up, volume goes down. So this does not tell me too much other than this big move here was not supported by a lot of volume. I would like to see volume coming back in on up moves and coming out on down moves. So that kind of negates this thing for me. I mean, the only bit of good news that we had was that we bounced hard off the 200 EMA. Whether that momentum holds or not, going into next week remains to be seen. Now we're wrapping down earnings, but next Wednesday we've got a key number coming out. It's CPI. All right, that's coming out on Wednesday when the Bureau of Labor Statistics releases its consumer price index for the entire month of October. Most economists are looking for a 2.5% rise year over year. Remember, in September is 2.2. So if it is more inflationary, because it is a measure of inflation at the consumer level, then the Feds are going to still stick to their 4 more rate hikes. And I think it will be very negative for the market. So Wednesday is going to be a key date for that. Okay. And also on Wednesday, which is not as widely followed in the press, but we're following it because we're watching it. It has a potential to be a contagion effect. Is the ECB has got a deadline for the Italian government to submit their amended 2019 budget draft to bring it more in line with the European rules, right? And Italy is kind of being run now by populists who are telling them to kind of go take a hike. So that has the potential to really deaden some of this gain here, even in Europe for next week. So we certainly have a couple of key things happening next week for that. Now, the bond market's going to be closed on Monday for Veterans Day. The rest of the market, I believe, is going to be open, but the bond market will be closed. The pits will be closed. The government post offices and everything will be shut down on Monday. So this is kind of where we're sitting. Now, if I put all of my indicators back on the screen again and just kind of muddy the waters, you can see these are the key levels that we've got. You can see the key numbers that we're coming in with. We're just slightly off the 2018 open. So we don't have enough lift yet to really see anything of substance. If we look at NASDAQ, which is really the one that's been punished the most, right? If we look at NASDAQ futures, it was down over 137 points. We're nowhere near doing a double top here. We've got the key pivots, and this again would suggest, and notice here we closed slightly below the 200 EMA. All right, here's the 200 EMA, and we're slightly below it. And we're on this upsloping trend line here, and it's trying to hold. But I do believe that this thing could get a lot uglier. All right, there's still some sector rotation going in the technology sector. So we've got to follow that very closely. And the Dow, believe it or not, is the one that has the strongest looking chart. Look at the Dow. Not only are we over the 200 EMA, we're over the 50 EMA, and we're moving up here. And before you get too giddy on all of this, I want to remind you, and for our members, I show you every Sunday. We've got a chart that charts the relative performance of the Dow versus the SPX versus bull and bear markets. And whenever the Dow is outperforming on a relative basis the SPX for at least 6 months, that heightens the risk of the markets rolling over. All right, because safety seeks larger companies, and there are certainly them in the Dow, right? And even though we've got a stronger dollar, which tends to suppress Dow earnings more so than others, because more of the earnings of Dow companies, the companies that make up the Dow index, are they get more than 60% of their earnings offshore. It still supports on a relative basis the Dow versus the S&P or versus NASDAQ. And then the one that really looks ugly. Let's look at the Russell futures right here. Well, let's just look at the Russ index. If we look at the Russell index, all right, look at what happened here. On the 1st of November, we had a death cross in the EMAs. I don't think the SMA, simple moving average, has crossed yet, but it's pretty darn close, where we've got the 50 going below the 200, and now they're starting to even out a little bit. So that is not a pretty thing, right? And if I just take it out just a little bit and show you the last time that we had this cross and the 50 was below, and let me just go out in time to show you the timing of this thing right here. Let's just move it back out here. You'll see with the Russell, it happens a little bit more often. But the last time it moved below was back in August of 2015 when the Chinese devalued the yuan. And we pulled back over 15%. In most markets, and the Russell pulled back a really almost in bear market territory, right? And then it just got very ugly, and then it was able to work its way back up. And it took, and by the way, it was down in August of 2015, and it took till about 10 months later, July of 2016, for the 50 to regain again. And we haven't been below until this big, huge meltdown that we had going into the Russell on a relative basis. Um, you can see this huge meltdown that we've had here. And we're near the 2018 lows. We're slightly in the green for the year for the Russell, but you can see this move here. Now, this move at this cross point tends to be at a resistance point, which also happens to be in a resistance zone for the Russell. We got to follow this very closely. This basically, the Russell is kind of a canary in the coal mine in that it's a vote on the U.S. economy because it's mostly small and mid cap stocks. So we've had this huge rally here, but we've got to see if we can hold up at this point. If we look at the volume, you can see here because I'm doing the RUT index, there's no volume. So, and I didn't want to use the Russell because this index right here, the new Russell index, I don't have enough data on it to really be able to measure longer term trends. So we're using the RUT, the cash index for the RUT. But you can see here it's very, very ugly. If we look at volatility, you can see the zones that I've got colored on the volatility chart. We've given it up, but we stayed in the month of October. I think we saw over 12 days with the VIX over 20. And we haven't seen that since getting back in this area here, right? And even then it was rare. But we've had the VIX over 20 in this area here. And so I think we're prone to having heightened volatility, at least through the end of the year. Now, keep in mind, November and December tend to be a very, very bullish month for the Russell primarily, and then for the other indexes as well. So we're going to watch these and see if seasonality kicks in or the Trump train takes over and the trade tariff issues just become front and center. All right. Now, keep in mind, the markets have already forecasted. It's come in just a little bit, but it's still over 75, close to 80% of a rate hike in December. And I think it went up when the Feds came out and reiterated in their policy statement this past week or so, where they're still on tune for a rate hike. And they seem to be disregarding a lot of talking heads on TV, including Trump, to slow down their rate hike. I think Jerome Power Ranger Powell wants to leave the thought of further rate hikes on the table to prevent an excess bubblicious market. I think he's doing that on purpose. I think net they're going to slow down next year and listen more to the bond market and maybe have a rate hike in January at Q1, or maybe not. Keep in mind, one other thing that I haven't seen anybody reported on yet is the Feds in 2019 are now going to hold a press conference every month. Traditionally, they've done it every quarter, which the markets have got used to rate hikes only happening at quarter end. Now that they can do a press conference every month, they've got a little bit more freedom. Now, the Feds have come out and adamantly said that they're not going to use that as a chance to hike rates more often, but it gives them that opportunity. Okay. So that also sends just a little bit of noise into the markets. And of course, if we look at treasuries here, we're using any move higher in treasuries as an excuse to possibly sell off. We did see this move higher on Friday in the treasuries, and if it moves much higher, I'd be more than willing to sell into it. You can see this regression channel here, and let me just kind of move it down here. You can see the regression channel. We're just following this line lower. We're near the 2018 lows in bonds, which, looking at the 10-year interest rate, we're near the 2018 highs, right? Right here. We've got a little bit of a bearish divergence here in the rates. So this tells me that we're going to get a settling in of rates, at least through the end of the year, because now the markets have already priced in a rate hike in December. If we get a really strong CPI number this Wednesday, I think we'll see interest rates move higher, bonds move lower. Okay, so that's a little bit about where we are with the rate story. And then, of course, if we look at currencies, and we come down and we look at the dollar is just blasting higher. I said we could probably come up, touch the 2018 highs, but I still believe, and we did not have a divergence here from this high, prior pivot high to this pivot high. But I think we're setting up for divergence here. We may poke our heads up above, but I think the dollar is going to come back in just a little bit. All right. I think it may get ahead of itself. And, Super Mario Draghi and Power Ranger Powell are in talks all the time. They're trying to do coordinated effort between the dollar and the euro. Remember, the euro drives the dollar. All the other currencies as a basket drive the dollar index. The dollar is not like the euro. The dollar really is an index of other currencies against the US dollar. So that's kind of what I'm looking at here. So Power Ranger Powell will probably work with the euro. I believe the euro will fail over the next decade. I just don't see him getting all those little Indians and cats together, all those southern countries in Europe, which tend to be more socialistically run versus the northern countries. And I think they're just really pissed off at most of the controls coming out of Germany. So, which is the strongest country in Europe right now, outside of Great Britain. Great Britain just came out with good GDP numbers, so it makes them number one right now. But Great Britain's getting ready to break away from the EU too. So the whole Brexit story, there's a lot of turmoil going on in Europe that could wash on our shores. But that's what I'm looking at for our currencies right now. If we look at metals, as you guys know, and I've been saying here, I have been bearish, not bearish, neutral to slightly bearish. Gold, I don't see gold holding these levels. And as you can see, it's giving it all back up. And we're coming right back into our level here. Now, the play in gold is really in the gold futures market. I like selling puts south of the 1150 area. I don't see gold coming below these 2018 lows. And you can still get premium in gold down to around 1100 strike. And I like those kind of trades. You can also come up here and iron condor the thing, do maybe an unbalanced condor, a UBC, and put some calls on as well, because I don't see gold busting a move back up here either, because gold hates higher interest rates and a stronger dollar. And I don't see interest rates. I can see, on a basis point basis, maybe interest rates coming in just a little bit, but trust me, longer term, interest rates are going higher. And that's going to put downward pressure on gold right now. Now, when we start to get into more of a recessionary environment, we start to see inflation show its ugly head, and we see the Fed starting to back off. That is when it's going to be time for us to look at more of a bullish activity in the precious metals market. Oil. Well, I'm going to pat myself on the back on this one. This was a trade I was telling our members, and I guess you guys here too. We need to go short oil. Now, it really overshot what I thought. But up at this level here, if you guys remember, I said I am not a believer in long oil. Or if you guys recall, back in this area here, I was saying, the markets were saying, Goldman Sachs, JP Morgan, Citi, all those guys, especially Goldman. Every time Goldman comes out with an oil forecast, I usually go the other way. They were saying, if you guys recall, $100 barrel of oil coming up in the next 6 months. And we went from 76.90 in West Texas Intermediate crude to close down here right now at 59.87. Okay. You can see here we tested the 200 EMA. We tried to get elevation. We couldn't. We did another retest. And then when it broke, that was another entry point. You had a retest here of the 50 EMA. We moved up. We did a retest and we broke. So if you didn't get this break here, there was another entry point here that you could have gotten in. If you missed that one, here was another entry point that you missed right here. These folks are trades that just are sitting there for the taking against market high paid analyst advice of $100 barrel of oil. All right. And this is kind of where we're going right now. Now I'm starting to change my tune, and I'm looking at possibly trading a longer term consolidation in oil in the mid 50s to slowly work our way back up again. Even as I speak, we're getting OPEC meeting. They're probably going to come out and look at cutting production again. But I think the relevance of OPEC is waning with the stronger oil output. Oil right now out of the U.S. is now already surpassed Russia and Saudi Arabia as the largest oil producer in the world. So go frackers go, right? And this has just been a wonderful trade. Remember, it's $1,000 a point. So, and we've got members that took this trade. They've emailed me and offered to buy me a steak dinner on this one. So, and let's assume you never did take the high point, but let's assume you took the initial break here, which was around $73 a barrel, and you're still in the trade right here, right? And you're at 59, so call it 60. So that's $13 a contract. That's $1,000 per futures contract move. And I know we've got members that took two or three of them. So you're looking at $20,000, $30,000 in profit on this one trade. So that really turned out to be a really strong one. The other trade that I was recommending, if we look at this one here, this right here, this is the spread between WTI and Brent. Okay. Notice we're hovering at this level here. It is not ready for a trade yet. We took this trade back here, back in the summer months of this year, to the downside. Again, just like oil, it is $1,000 a point. It's holding up right here. I think it could come back up in this level up here, but the minute it breaks to the downside, we're going to trade it again to the downside. It's not ready to break yet, but when it does, we're going to make a nice move in it. All right, everybody, that's my really quick update for this week. If you're not in our group, I highly encourage you to come in. We're having a lot of fun, and as you can see, for those of you that are taking trades that we're running here, they're working out very nicely. Otherwise, members, I will see you this Sunday night. And then we got another Option Masters coming up this Thursday evening. That's another area that we're really diving into, things that a lot of people don't cover in their training programs, meaning risk management, position sizing, which accounts for the bulk of risk management, building trading plans, and then reading and deciphering stock charts so that you can get your bias right, and then selecting strategies that match the bias and the market regime that we're looking at. These things are so important to longer term success. Highly encourage you to come in and check us out. Members, I'll see you this Sunday evening. Take care, everybody. Have a really great weekend. For all of you military members out there, God love you. For Veterans Day, I send all my best wishes to all of you out there. Take care, everybody. Ciao.